corporate finance, again, it's a much more nuanced role, and this role, again, for listed companies, there is a dedicated department for corporate finance, M&A, investor relations. For smaller companies, say they typically don't have a department, but as a consultant, they basically hire consultants for this work because this work is a lot more episodic in nature, in a way that at a smaller level, companies generally don't do a lot of acquisitions, a lot of fundraise or divestments, etc. So this role of full-time sits typically with the large listed companies and also with private companies, but those such private companies need to have a huge size in terms of their sales and the overall business numbers. So what happens in corporate finance? In corporate finance, this is typical. If any of you are having, for example, if you did CA and you guys have SFM as a favorite subject, or let's say if you are doing CFA, then you can easily relate to these topics. Firstly, it is a capital structure where you guide or you understand what kind of capital structure should your company have, okay, in terms of debt versus equity mix. Because with evolving scenarios, there are a lot of instruments in terms of debt coming up, nuanced instruments, innovative instruments, where now there is a very niche area of structured finance that is coming up, where you have multiple forms of taking debt. It can be pure convertible debt, non-convertible debt, then you have private credit, then you have structured finance. So a lot of instruments for that, and same goes with equity. You have vanilla equity shares, then you have preference shares. Common instrument nowadays being used by startups is CCPS, which is basically compulsory convertible preference shares, where investors act as preference shareholders for a certain period of time or a certain event, and once the period gets completed or the event or the subsequent fundraise is done, then the preference shares ultimately gets converted into equity shares. Why startup or basically why the investors do so? For some sort of protection in terms of liquidity that they get, because preference shareholders are always preferred before the equity shareholders in case of liquidation or otherwise. In capital structure also comes negotiating credit lines and bonds. Basically, if you have some existing debt in your books, how can you refinance those debt? Is there a possibility to refinance and reduce your borrowing cost? Is there a possibility to restructure your finances in a way that helps you, under leverage your position? So, for example, if you see that the company is having a high leverage position against its performance, then is there a possibility to refinance it? This is that comes under negotiating credit lines, managing the cost of capital, where you constantly choose in deciding what should be your ideal cost of capital and against what cost of capital are you operating at. Basically, managing the cost of debt and equity. Rating agency relationships. This is very important because when you're raising debt, rating agencies give you a rating, okay, that for example, are you a plus company, or are you a plus plus company, or are you a B company or a B plus plus company? So you need to have strong rating agency relationships in order to ensure that whenever you are raising debt, so those rating agencies give an appropriate rating to your company and to your debt instruments, so that the investors can have a sufficient comfort when acquiring your debt instruments. Shareholder return frameworks. This is very important because when you are having investments from various stakeholders, be it individual investors or HNIs or private equity players, venture capital players. So it's important to understand that how are you managing shareholder returns, how are you managing buybacks, how are you managing dividends, and a lot of other aspects that comes into picture, where you have to manage the returns and what kind of returns are you actually giving out in terms of dividends, and how much are you retaining within your own company for growth purpose. Then you have M&A investments, where you from a company lens, where you typically source the targets as to firstly what kind of acquisitions are you looking at. Then you prepare valuation models for those targets. Once you have targets identified, then you prepare valuation models to actually come up for a particular number as to how much are you willing to pay for that company. Perform due diligence on that company to ensure that whatever numbers they present are accurate in terms of their performance, their loans, their sales, profits, etc. Integrate acquired businesses. So once you have acquired, how do you actually integrate those businesses within your business in terms of not just finance or operations, but also culture, so that your extended company looks like a one unified company in terms of strategy and culture as well. Divest underperforming units. So one is acquisition. At the same time, you also need to divest, because if, let's say, in your entire business there are, for example, 4 business units, and if you see one business unit not performing well, then you may have to sell those units. You may have to demerge that unit separately. Demergers are very common. For example, if you have a one business unit performing exceptionally well, other than the I mean better than the remaining units, then there's a possibility to demerge that separate unit and command much more valuation for that unit, and basically earn much more leverage. So in many cases, demerger is also an interesting option, where you demerge a particular unit out of your entire business. Treasury and cash management, this piece becomes much more important in terms of global operations, because right now, as we all foresee that yeah, there is a constant tussle between INR and dollar, where INR is getting weaker, not just against dollar, but against many other multiple currencies. So let's say if you are having transactions, import transactions, export transactions in foreign currencies, then you need to hedge your position against all the volatilities that is happening in the market. So the hedging becomes much more nuanced and important aspect in corporate finance. Investment of surplus funds. If your business is generating surplus funds, you need to have an idea. You need to have an insight as to how can I generate returns on the surplus funds. So you have to balance the risk versus return framework for these surplus funds to ensure that these surplus funds are parked in a way that is giving you optimum returns for the chosen risk appetite that you or your company has. Bank relationship management, again, when it comes to hedging, that hedging or other risk mitigation strategies, you are constantly in touch with your bank to ensure that you get appropriate hedging products with least cost of hedging, because hedging is not free. Of course, hedging comes with a cost. So you need to have a mental model framework that what kind of volatilities are you seeing in the market, that is there even a worth in actually hedging, because it shouldn't be possibility that you forecasted that there will be a lot of volatilities and you enter into a hedging, but it turned out that there were no volatilities, and hence you were not actually exposed to any forex risk. But at the same time, because you entered into a hedge, you actually paid the cost of hedge to the bank. So ultimately, your position turned out to be loss. In some cases, you have to be very prepared that some cost of hedging will be involved, but at the same time, you have to see that hedging gives you an opportunity to keep your balance sheet secure. You won't be in a position toward exposure, so you are prepared that okay, this is the hedging cost that I'll be incurred irrespective of whatever comes out, and at the same time my balance sheet is secure. So companies a lot of times don't see towards hedging cost. They deliberately take hedging cost, but at the same time they are ensured that okay, my forex position is secure. Working capital optimization, again, it's very important that how do you manage your working capital. As I mentioned in the earlier example, that if your receivable position is getting increased from 30 days, 35 days, 45 days, then ultimately what is happening is the cash is coming very slow in your company. At the same time, if your payables are fixed at, let's say, 30 days, then what is happening is you have to pay within 30 days, but you haven't recovered your money from the market within 30 days. So this puts strain on your balance sheet, because you have to ultimately borrow from banks in terms of working capital to finance that payables or inventory. So ensure that the working capital is completely optimized, be it receivable days, payable days, inventory days. And we may think that this is very basic, but I have seen a lot of companies actually being failed in the market simply because they were not able to optimize or improve their working capital position. So coming to skills, as I mentioned, valuation is a very important skill to master when it comes to corporate finance. Again, financial modeling, capital markets knowledge is important as to how the broader capital markets is performing, what kind of beta or what kind of risk the investors or the broader capital market participants are perceiving. And negotiation is important, especially in terms of negotiation with bankers for the rate of interest. Second is the hedging cost. Third is what kind of leverage they can provide for the same rate of interest. So negotiation is important. And in terms of education or the knowledge, CFA and CA both are preferred. CA because from a regulation lens point of view, CFA predominantly from the finance lens point of view.
Rishabh,
Yes.
listen, what I was saying is, uh, don't you feel people, focus a lot on investment banking, and all those profiles, but over your corporate finance, how, the the timing and the work-life balance will also be different, is what I feel. Even though the pay would be very high in investment banking, corporate finance may, the timing would be substantially less. Will this not be the case? Or you can let me know in your experience what happens.
So, so first we need to understand that why investment banking has this, I would say stretched work-life balance, because the timeline of the deal is very short. You have to execute the deal in a very limited time frame, and hence, if you have to dedicate or if you have to complete entire work in a limited time frame with the limited set of resources, then all the resources are stretched. And when I say resources, basically people. Okay, so
Hmm.
and that is the reason that the timelines in investment banking are much more stringent and much more stretched, and that's why the work-life balance issue comes. Now
Correct,
coming to
correct.
corporate finance or any other field that I mentioned, FP and otherwise. So of course, the work-life balance is better than investment banking, but again, in corporate finance, if you are dealing with work that is related to investment banking, for example, something like M&A, okay, in that
Mm-hmm.
specific time frame, you may be stretched, okay, because
Correct, correct.
deals, be it in the context of corporate finance within a specific company or as part of investment banking, the deals are always time specific. It's not like, okay, we will do the deal, we'll analyze the target, we'll do when we have time or something like that. It is always restricted in terms of time frame because the deals need to be closed faster. Because deals happen for some specific reason, and unless deals are not happening, that specific reason is not serviced or justified.
True.
So even in
Absolutely.
corporate finance, specifically when it comes to M&A or investments, you may have a weak work-life balance during that specific period in the company.
Thanks. Thanks. So, also, everyone, guys, I was recently now analyzing a company called Sammaan Capital, and I could just recall because of what Rushabh was saying right now. I just there's an NBFC called Sammaan Capital. Okay. Recently, what happened is a new promoter actually acquired the company. IHC Group acquired Sammaan Capital. So all the three credit rating agencies that we have in India, the Crisil, ICRA, CARE, all of them re-rated, gave them a better rating because the promoter has changed. Guys, do you know what happened? Because of that immediate impact on the cost of capital. Rushabh bhai, क्या हुआ कि the cost of capital reduced by 2%, and the company is claiming in some of their presentations as well, they're now able to borrow funds at 2% lower than what they used to do earlier. Because earlier it was a very stressed enterprise. Now, because the promoter has changed and they are claiming that they'll clean out the balance sheet and everything. So how important is capital structure is also very important, because they'll be able to get funds at a lower cost now. Okay, they'll be able to give loans which are not very risky to earn that high profit. They can give a low risky loan also. So now the probability of NPAs will also go down. Correct? So the whole cycle improves. So I feel everything starts with capital structure. If you're able to borrow funds at a lower cost, okay, you yourself start being more, your probability of being profitable increases substantially later. अगर आप आपका cost of funds ही बहुत high है, your cost of capital is high, then your ROC or ROE won't be very high, then you won't be able to earn a lot, I feel. Correct? Yeah.
No, absolutely, and that's why So there used to be a concept called as trading on equity that we learned in CA as to how for example, if your return on capital employed is say 15%, for example, and if you are getting that at say 10%, 12%, then how raising debt actually helps you earn 3% on your overall finance on your overall capital.
Correct.
Okay, because
Correct.
you are raising at 10% while you are actually generating at 15%, giving you an
Correct.
incremental 5%, right?
Absolutely.
So of
Yeah,
course,
yeah.
capital structure is important, and the more you are able to raise at a lower cost of capital, the better for
Correct.
you because you are ultimately generating money for the actual equity shareholders.
Equity shareholder.